I imagine that all of us are starting to notice the stock market is becoming more and more expensive. I am personally having a hard time finding good deals out there. So in today's video, I want to take a look at what these super investors are buying and where they are seeing value in our expensive market. By taking a look at what they are buying, we can find new potential investment ideas for ourselves or see if we agree with them. As always though, I don't think it's ever a good idea to follow anyone's investments blindly without doing our own research first. Just because the smart money is buying something doesn't mean that we should. But let's take a look at what they are doing and see if we can get some new ideas. Alright, so let's just start off with the fifth stock that super investors are buying. And this one has the ticker symbol FISV, which is FISV. FISV is a fintech company that has a few different sources of revenue. They offer services such as points of sale, digital banking, online payments, and more. Basically, they seem like an all things fintech company, and the business has been seeing great growth over the years. In 2010, FISV did $4.06 billion in revenue, and by 2018, the company produced $5.8 billion. This is a revenue growth of about 43% over those 8 years, which is a compounded annual growth rate of 4.75% to the revenue every single year. However, in 2019, FISV did a major acquisition of First Data, which shot the company's combined revenue to $14.5 billion for the year. We can see here that FISV's revenue has continued to grow, and in the trailing 12 months has now produced $15.4 billion, which is an all-time high for the company. So far, it does look like this acquisition is paying off and allowing the business to continue seeing more revenue growth and growing altogether. However, the acquisition also shot up FISV's price-to-earnings ratio, and it is now sitting at 67 at the time of recording this video. So right off the bat, if you're looking at the price-to-earnings ratio, then this seems like a very expensive company, right? Well, check this out. In FISV's most recent earnings, they reported net income of $269 million. But they also paid $148 million in mergers and acquisition costs and $513 million in amortization related to the intangible assets they acquired through the same acquisition. These are costs directly related to the acquisition, and the amortization in specific is actually a non-cash expense for the business going forward. This number right here is simply an accounting write-off, and without the acquisition, the company would have actually reported about $921 million in net income in this second quarter, which means FISV is actually a very profitable business that is producing very strong earnings. Further down, they also show us that they reported 40 cents in earnings per share, but with these adjustments from the acquisition, they had $1.37 in earnings per share, which is over 3 times as much net income. In the same Q2 reporting, they gave 2021 adjusted earnings per share guidance of $5.50 to $5.60, and adjusted earnings per share growth of 24 to 27% for the year. This basically means that without the acquisition costs, which I believe are a short-term expense, and the amortization of the acquisition, which is a non-cash expense, the business is producing much more net income, and the net income is growing very nicely. FISV sells for $116.88 at the time of recording this video, which means they're selling for a forward price to earnings ratio of 21.5 based on the adjusted net income for 2021. We can also see here that analysts have the company selling for a 12-month forward price to earnings ratio of 20.5 and a price to free cash flow of 22.966 currently. The free cash flow simply takes out the non-cash expenses and shows us how much money the business is actually producing. And in this next chart, we can see how much lower the price to free cash flow is than the price to earnings ratio. Once the amortization of the recent acquisition stops, then the earnings should increase to be much more in line with the cash flows once again. If we also take a look at FISV's historical price to free cash flow, we can see that it's right around its historical mid-range currently. On top of this, FISV has been using the free cash flows to buy back shares consistently since 2005, and in the trailing 12 months, they have repurchased over $1.5 billion worth of shares. On a percent basis, so I'm just taking the amount of shares repurchased divided by the market cap, this is just under 2% return to shareholders through stock buybacks in the past 12 months using the company's free cash flows. Analysts are projecting FISV's revenue and free cash flow to grow by 20% and 62% respectively by the end of 2023. So analysts are expecting FISV to continue growing its business in the future and increase the cash flow margins as well. If FISV can maintain a 22 price to free cash flow ratio and meet these 2023 projections, then this company could be selling at a $118.4 billion valuation by the end of 2023. which would also increase the market cap 55% above the company's current valuation. And as the cash flows for the business increase, I do expect the share repurchasing to increase along with it. But basically, this is a company projected to see adjusted earnings per share growth of 24 to 27% in 2021, and analysts are expecting the revenues and the cash flows to continue increasing substantially by 2023. And yet, the stock is selling for about a 20 to 21 forward price to earnings ratio and a 22 price to free cash flow currently, which could be why super investors have been buying the stock in the second quarter. On top of this, FISV shares are still selling below where they were in 2020 before the stock market crash, which again could be another reason why super investors are interested in this company. Moving on, Netflix is the fourth stock that super investors have been adding to, with a total of 7 super investors buying this stock. Netflix has always been a very interesting company to me because it's a super high growth stock that seems to always be expensive, and arguably for a good reason. Netflix's revenue has been growing very well since 2006, and every year it seems like the company is finding new ways to continue bringing in more and more revenue, and the revenue just continues on growing. They have actually been aggressively pursuing the Asia-Pacific markets, and in the past years, this is where most of Netflix's growth has been coming from. This chart right here shows us Netflix's revenue growth by region, and we can see that the Asia-Pacific region has been growing very well over the recent quarters. Asia-Pacic's revenue is actually about to surpass Latin America, and I believe this revenue growth from Asia will continue into the future. If we take a look at the percent of the populations with a Netflix subscription, we can see that the Asia-Pacific region is very much so untapped by Netflix still. In India, for example, only 0.36% of the population have a Netflix subscription. That's about 1/3 of 1%. In comparison, in the US, over 20% of the population has a Netflix subscription. This suggests to me that the Asia-Pacific market and India can provide more growth for Netflix in the coming years. Over the next few years, analysts are also expecting Netflix's revenue to grow by over 40% to $38.9 billion. So it looks like analysts are not expecting the revenue growth for Netflix to slow down anytime soon either. The price to earnings ratio for Netflix is right under 60 currently, so on a price to earnings ratio basis, this does seem like a pretty expensive stock, still. But if we take a look at the past 6 years, we can see that Netflix's price to earnings ratio hasn't ever been this low. Over this time, it's usually traded above 100. So yes, Netflix's price to earnings ratio is still 60 currently, but relative to how this stock is traded in the past, it does look like it could be getting cheap. I also personally think that the price to earnings ratio is coming down because the net margin is starting to go up. This chart right here shows us that since about Q3 of 2016, Netflix's net margin has increased quite dramatically, which simply means more of the revenue is turning into earnings for the business and for the shareholders. The net margin is sitting at just under 16% currently, and I do expect this to continue growing as a business continues maturing over the long term. Ultimately, though, it looks like super investors are bullish on Netflix's continued growth drivers and are expecting the growth to continue over the coming years as the company continues capturing more of the Asia-Pacific markets. But now let's move on to stock number 3 that super investors are currently buying, which is Amazon, with 9 super investors adding this stock to their portfolios. I've been talking about Amazon on my channel for a few months now and trying to explain why I believe the business is currently attractive. So let's take a look at why super investors may be thinking the same. First off, Amazon's revenue has been growing insanely well over the years, and in the trailing 12 months, they produced $443 billion in revenue. Amazon has been one of the best growth stocks to own ever, and I think that Amazon's growth will only continue in the years to come for a few key reasons. First off, the overall e-commerce market is projected to grow by $1 trillion over just the next 5 years. That is a lot of growth for Amazon to continue capturing. Amazon is continuing to invest in capturing this growth as well, and they have been investing pretty heavily into more warehouse space and fulfillment centers. This article right here actually says, Amazon is set to add 517 facilities to its global distribution network in the years ahead. That's 176 million additional square feet being added to over 402 million square feet the company currently utilizes, and over the past 12 months, Amazon has increased its capital expenditures and equipment leases by 74% to $54.5 billion. These capital expenditures in capturing more growth are causing Amazon's free cash flow and operating income to drop in the short term. But even despite these drops in operating income, Amazon's price to operating income is still around its historical average. I personally actually like that Amazon is investing in more growth, and I think that these investments will pay off over the long term for Amazon in the future. Amazon has also been spending billions of dollars investing in India's e-commerce growth over the years, and Jeff Bezos has previously said that he believes the 21st century will be the Indian century. The reason Amazon is investing in India is because the Indian economy is projected to become the 5th largest economy in the world by 2025 and the 3rd largest by 2030. It's no coincidence that so many companies are focusing on India and trying to capitalize on this country's growth, and Amazon is one of these companies. Amazon is projected to see its revenues continue growing in the future, and by the end of 2023, analysts are projecting revenue to be about $655 billion, which is about a 50% increase from today. Once the capital expenditures are over with, then the cash flow is projected to bounce back and hit record highs as well. So Amazon is currently in a period of a short-term drop in earnings and cash flows to invest in more growth. And I, for one, think that these investments will pay off for the company. And it seems like both super investors and analysts agree. All right, but now let's move on to stock number 2 that super investors are buying. And this one is Facebook. Facebook has been kind of a controversial stock to own over the years, and it's currently sitting at an all-time high. So let's see what super investors might be seeing in this company. Back in March of this year, banks were increasing their price targets on Facebook due to a strong ad trend and e-commerce growth. For those of you who may not know, Facebook is an advertising giant, and the company is the leader in online advertising. Since so many businesses were forced to move online over the past 18 months, Facebook has seen the revenue explode. I mean, think about it. If your business is online and you're trying to promote it, then you're going to have to use Facebook ads. And as we have already learned, the e-commerce market is projected to grow by $1 trillion by 2025. So with Facebook being a leader in online advertising, they stand to benefit massively from the growth of the e-commerce market. Facebook is another company where the revenue has been exploding as well. And in the most recent quarters, growth has really picked up again. There is a clear trend change in Facebook's growth, and it seems like these tailwinds to the business is going to continue in the future. What's interesting about this is despite Facebook seeing increased growth rates in the past year, its price to earnings is still selling around its historical average over the past 4 years. And some could argue that Facebook's price to earnings is quite low relative to the amount of growth that the company is seeing. Facebook's net margin has been increasing since hitting a low in 2019 as well. It's not quite back up to where it was in 2018, but the company's margins are seeming to improve right now as well. If this trend continues, then Facebook's earnings could see accelerated growth in the future. Lastly, analysts are projecting Facebook to continue seeing growth out to 2023, and they're projecting both revenue growth and earnings growth of about 60%, which is really significant growth for the business in just the next 2 years. So to me, it seems like super investors are buying Facebook as a bet on continued e-commerce growth and continued tailwinds for the online advertisements flowing through Facebook's platform. The valuation doesn't seem insane based on the company's growth right now either, and relative to how the company has been valued in the past. Alright, but now let's see the number 1 stock that super investors are buying. Which stock have they been buying most? Well, it's none other than Alibaba, with 12 super investors buying it. I have also been talking about Alibaba on my channel for some time now, so I don't want to repeat too much of the information I have already shared here, and I will just discuss this one briefly. Alibaba has been a very controversial stock this year, and the company has lost nearly half of its value from its recent highs set in October of 2020. This is because China has been doing tons of regulatory crackdowns on their business, and investors are worried that China will slow down Alibaba's growth or totally derail this company. However, as Warren Buffett says, be fearful when others are greedy, and greedy when others are fearful. The fear surrounding China in general right now is causing Chinese stocks across the board to see massive price compression, and it's why these stocks are becoming so cheap. However, Alibaba has seen fantastic revenue growth over the years, and continues to grow the underlying business very nicely, seemingly every quarter. Alibaba's revenue has actually been closing the gap on Amazon's, and time will tell if the business can continue matching Amazon's performance over the long term. Despite all of this fundamental growth, however, the price-to-earnings ratio for the business has not been this low since 2016. Again, the low price-to-earnings ratio is simply due to how negative the sentiment is around Chinese stocks right now. Analysts are projecting that Alibaba as a business will continue seeing strong growth over the coming years though, and by the end of 2024, they're projecting the revenue and the cash flow to increase by about 80% respectively. That is really, really strong growth, especially for a stock that is selling for a 20 price to earnings ratio today. One of the main reasons for this growth is because China's economy is projected to become the largest economy in the world by 2028, and Alibaba is one of the largest companies in China. So as the overall Chinese economy grows, Alibaba should grow alongside with it. So to me, to put it simply, I think super investors are buying Alibaba shares because the company is one of the best companies to own and the fastest growing major economy in the world. The valuation is also reaching its historical lows, yet the growth isn't projected to slow down anytime soon. A 20 price to earnings ratio in this expensive market suggests to me that investors are incredibly bearish towards this company right now, and that sentiment is very low. However, it seems like these super investors are focusing on the underlying business of Alibaba and its future potential, and not what the market is currently thinking. Time will tell if these super investors are right, but for now, this is the #1 stock that they are buying. And with all of that being said, that is going to wrap up the video, everyone. If you enjoyed this video or you found it helpful or insightful in some way, then please remember to leave a like on it. It really helps out my channel and I really appreciate it. Also, if by chance you're new here and you want to stick around and see more content like this related to the stock market and what's going on in the stock market, then please consider subscribing to my channel too. But with all of that being said, thank you all so much for watching my video, and if you made it to the end of the video, then as always, just an additional thank you. There is nothing that helps my channel more than you all watching the video to the end. So again, thank you so much, and I really hope to see you all again in my next video.